Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Dennis Dick, and I have Paul Mladjenovic on the line. He's the author of Stock Investing for Dummies, and also known as the Raving Capitalist. How you doing this morning, Paul?
Oh, good morning. Happy Thanksgiving to everybody. It's a pleasure to be on.
So the Raving Capitalist, is that something that you bestowed upon yourself, or is that something that that's been assigned to you?
Well, here's the thing. I was born in a communist country, and I used to joke in my classes because I've been teaching about investing and business startup for like over 30 years now. And when I introduce myself in the beginning, I say I'm a raving capitalist, and that's because I was born in a communist country. So it stuck. So I figured, hey, why not? You know what I mean? So it became ravingcapitalist.com. So thanks for asking.
How long ago did you write Stock Investing for Dummies, and what inspired you to write that book?
Well, I'm telling. Well, first of all, the at the time it was I believe it was Hungry Minds was the publisher. They had contacted me, and I was actually at the time surprised they didn't do a book already on stock investing, but I was most grateful to be called to do that. And I remember that the first edition, I finished writing the first edition the night before my second son was born. And so, in other words, that month, that was March, I gave birth to Stock Investing for Dummies, the first edition, while my wife did the hard work with the next child.
Okay, all right, Paul. Well, it's probably a really good time to have you on because you've written a lot about market tops and bull markets, and boy, I mean, we're at a point here where the market's just had a tremendous run. Why don't you give us like your short-term outlook and what investors can do to protect themselves?
Well, at this point, with the market being high, I mean, I'm not going to be shocked if it hits 18,000, et cetera. But although I do feel that over the last 2 years, the greatest impetus for this push has really been the Federal Reserve policy. There's been a lot of liquidity. When they pass money off to their member banks, those member banks are becoming more profitable doing their trades in the stock market than they have been like lending out to small businesses. So my feeling is that this is actually a time to be cautious more than anything else. I've seen lots of stocks, both profitable and unprofitable, go up, and I think it's really a time to reassess. I think that I'm still generally cautious about the stock market in general, but I think that stock investing is not a catch-all. I mean, there's many different kinds of stocks, and what I've been telling my students in my investing seminars in recent months is that if I had to tell people what to concentrate on, because I think that the global economy is getting more precarious. There's a lot of stuff going on behind the scenes that can have a tremendous impact on everything from the rate of inflation to the to money flows and debt problems and derivatives. I mean, I think there's a strong chance you'd see a severe pullback in 2015. This is part of my concern. I even did a video along those lines. So I think that number one, for those people, and and a lot of what I tell people is also situational. I mean, if right now there are retirees out there or pre-retirees who are doing very well, I think that one thing that I generally tell people, especially if they think they might need money like 3 or 6 months from now, is to start putting on trailing stops on their positions. I mean, if they had a stock they bought at 25 and it rallied to 50, it's probably not a bad idea now to put, say, a trailing stop at, say, 45 or so, whatever, to minimize the downside without, affecting the upside. So rule number one for those investors out there who may need money in the short term, whether it's for retirement, to cash out, or who knows, pay off a mortgage or college, et cetera, you don't want those paper gains to evaporate. So start considering, on many of those positions, trailing stops. Now, of course, if you're investing and you're looking at, an outlook of like whatever, 6, 7, 8 years and beyond, then, you just may want to rotate a little bit, but you could still remain generally bullish. But the short term, I'm getting very concerned. I think it's a good time now for speculators to maybe start buying some cheap long-term puts if they want to, play the short term, because now the puts are very, very cheap. And again, I don't know to what extent people in your audience, are onto things such as calls and puts. But, so generally very long-term, still very bullish. Short-term, very concerned. It could, because the thing is this, when markets pull back, it's usually not orderly. I mean, people don't rush for the entrance as quickly as they rush for the exit.
Yeah.
So these are my worries, especially since we're coming to a new year. Who knows if there's going to be any volatility in December or January as people aim for tax-related transactions, like for gains and losses, so to speak. So you let me know how much more I can tell you, because I can talk all day about this.
What's your thoughts on gold? Because we've seen a recent gold rally here in the last couple of weeks, but this downward trend in gold is very concerning for the gold bugs here. It seems like every time it rallies 50 or 60 or $70, just finds new sellers and eventually makes new lows here anyways. Do you think if eventually the stock market pulls back, that's good for gold, or it doesn't even matter?
Well, here's the thing. I mean, I feel that maybe the two biggest activities or forms of intervention, if you want to call it that, in the past couple of years is, number one, is the intervention to, that either directly or indirectly or purposeful or accidental or whatever, is that the Federal Reserve policy has been to, float the stock market upwards. So I feel much of those gains are a little bit artificial. So it is in bubble territory, and whether it extends or not, some more remains to be seen. Now, gold and silver, actually, the precious metals, I tend to think that they're a little bit in a reverse bubble, and what that means is that probably the gravest, for those people out there who are, followers of gold, I mean, they read all the people that I love, like David Morgan and Jay Taylor and so many others. And the thing is, you have a situation where you have some tremendous shorting by Federal Reserve banks, members of the Federal Reserve System, doing tremendous shorting in the paper markets over there in the futures pit. So it's been really artificially depressing the price of gold and silver. However, the thing is that ultimately the short-term paper gold wins, but in the long term, physical gold will win. So I tell those folks out there that, the way they have to be careful of with the stock market at the upside, on the downside, I think there are buying opportunities. I don't think that the bull market in precious metals is over, not by a long shot, especially since you have so much movement of gold and silver from the west to the east, to the point these acute shortages will have a very impactful, it will be extremely impactful on these prices. So I'm still on record as seeing long-term gold is going to go north of 2,000 and that silver is going to go north of 100.
Now, would you be out here buying the miners right now? Because these things have just been rocked. Obviously, their cost of production has really risen over the course of the last 5 to 7 years. Some of it's up $1,100, $1,200 an ounce. And we've been saying on the show, if it went under $1,000 an ounce of gold, if it continued to go down, that a lot of these miners could actually be in trouble. But if you're predicting that eventually gold might go to 2,000, that'd be real good news for some of these mining stocks.
Yeah, I definitely think so. And the thing is that, look, there are people who analyze the gold and silver stocks more than I do. I try to stick to a few positions that I think are quality companies that are diversified. I mean, right now, the only for the speculators who are looking at junior mining stocks, I think they're a great consideration, and I think that when in the next probably 3, 6, 9 months, they're going to have some buying opportunities. And when I say buying opportunities, they have to be companies where these speculators or investors are going to be privy to the financial statements, because a lot of junior mining companies are just not going to survive with these artificially depressed prices. There's some that are going to be going under, and it's going to be a sin. When you see that, for example, the price of silver is right now the public price for silver is now below the all-in cost of mining it. I mean, that's a bullish sign, but in the meanwhile, you're talking about a lot of companies in that sector suffering. I mean, I think there's going to be some outsized gains coming, but not until the shakeout is complete, and people who are within the sound of our voice are making sure that the companies that they are going to be considering are turning a profit, because if they're turning losses, then really you're not investing, you're speculating, to a great extent. So I feel bad, but the thing is that, what they say, the cure for low prices is low prices. When a lot of mines start to close down, whatever miners are surviving stand to make some outsized gains. when sanity returns to this marketplace.
Paul, I have to agree with you on that because when they had when we got near 1900, 2000, they were cranking up the mines and they were, spending money on R&D and I think a couple weeks back on the show I said, when I'm going to buy gold is when they start closing mines, that was a good indicator. You mentioned a couple of the junior miners. Is there any symbols that you would like to share with us for some of these stocks?
Well, again, whatever I mention out loud, I hope everybody within the sound of my voice understands I'm not providing advice because I have no idea about their situations.
Okay.
Right now, I'm not going to mention any junior mines at the moment. I just think that a couple of my favorite larger, more established companies, like I think Silver Wheaton, with the symbol SLW, is a consideration. Okay, so again, anybody who heard that, speak to your financial advisors to see if that's a good play. It's aggressive at this point, but I like that one. And Silver Wheaton also has lots of options on it as well. So for those people out there who want to put on option combinations and some bullish spreads, etc., it's not a bad candidate for that.
Okay, got a question in the chat here. Where are you from, and when and why did you come to the United States?
Yeah, I came from Yugoslavia, the socialist paradise of Yugoslavia. And I came to America in 1963 when I was 4 years old. And then I was able to watch from a safe distance in 1993, 1994, when Yugoslavia was falling apart, because people forget part of the reason why I like precious metals, and I wrote the book Precious Metals Investing for Dummies, is that look, I'm probably one of the few financial advisors who takes to heart on a personal level what happens to a country that gets consumed by hyperinflation. This is what happened in Yugoslavia. That was part of what decimated it, and then it became broken up, and then it became like Croatia and Serbia and so forth. So for me, since I'm very familiar with communism and socialism and how governments can impact markets and economies, that was part of what helped me, make some market calls that thankfully, came out well. I mean, like, calling the housing bubble, and I told my clients to stay away from that, and some other venues. And for now, I worry because I think that the economy can be a very shaky area. So the thing is that if the stock market is at a high and the economy is shaky, that's not a good combination, you see. So a lot of that came from my background. So yes, but today I'm 100% naturalized U.S. citizen. So I'm grateful to be here.
We got about a minute left in the interview. Got to get a stock pick or two from you there. What's your what are you looking at here right now? I mean, we have run up so far here. It's kind of hard to continue to find value in this market. But is there anything on your radar?
Well, if I had to give one thing for people, again, I have to, and they have to do their own due diligence, but I actually like a couple of ETFs. One of my favorite ETFs, okay, has the symbol HDV. And again, people do their due diligence on this one. And what HDV is, it's an ETF that basically has a fixed basket of securities, companies who have shown a track record of raising their dividend every year for 10 years or longer. And these are companies that are tied to one of my favorite things. Students in my classes know that I love to tell them, look, human need, let that be your guidance for what could be a core part of your portfolio. ETFs like HDV, you invest in like food companies, utilities, water, beverage. I mean, the kind of things that people will buy no matter how good or bad the economy is. So I tend to like that kind of holding because you get in one basket, the quality stocks have been raising dividends for a decade or longer. So that's not a bad play in today's uncertain times.
What's the nice yield on that ETF?
Yeah, last time I looked it was about 3.5, and it's and again, and people understand is that dividend payers don't fall as much as non-dividend payers, all things being equal, when there is a pullback or a sharp correction. So there's a little better level of safety, and plus the cash flow part is very important. I think dividends should be a crucial part of any long-term investing portfolio.
Okay, one last issue for you. John Vitale here in the chat just doesn't seem to. He can't get Apple out of his mind today. I'm not sure if that's a stock that you follow at all. What a tremendous run in the stock. Is that something that you follow or have in your portfolio, or is it just out of your wheelhouse?
Well, I think I don't follow Apple currently, but I think that if there's any stock that made the transition from being a high-tech aggressive play into something that's kind of almost morphed, not quite human need, but pretty close, because obviously it seems like every person is walking around with a gadget. So Apple is positioned very well. So it's entering its mature stage. So I'm generally favorable on it, regardless of where it might be moving in the short term.
Okay, all right. We've had Paul Mladjenovic on the line, and he is the author of Stock Investing for Dummies, and also known as the Raving Capitalist, outlining his views on the market as well as the commodities markets. Paul, thanks a lot. Great interview, and we hope to have you on again.
Oh, it was a pleasure. Happy Thanksgiving to everyone.
Thanks, Paul.